Hey everybody, Jerome Maldonado. We're live on Real Talk on Real Estate. Ladies and gentlemen, we had some technical difficulties, but it never stops us. We continue to move. And so, ladies and gentlemen, today I want to bring you guys the update on the July housing market update, economic update. And I like doing this every month because I like going through, getting the numbers, and giving you guys real statistics on what's happening. And so today on Real Talk on Real Estate, we have a lot to go over. So I'm gonna start in on a lot of what's going on right now with the housing market. And I know a lot of people want to know. There's been a lot of shifts in the market this month. We've seen interest rates rise well over 3%, and now they've dropped a little bit, so they're at like 3.1%. So they're back down closer to 3%. And so how is all of this stuff that's happening governmental-wise, economically affecting people? You know, we're all in this game together. I'm in this with you guys, and this affects everybody. So let's start off with all the technical aspects of everything that's happening, what's happening with lumber and what's happening with the inflationary market and the deflationary market, and talk about what exactly is happening in real estate and the housing market right now. And so I know a lot of people right now, if you guys comment in when you guys are watching this, let me know if you guys yourselves are kind of wondering where to invest over the next year. And if you guys in the chat, just say yes, just put yes in there. If you're trying to decide whether you should invest and you're interested in knowing where to invest, I'm going to go over all that stuff. But just type yes in the chat and click and subscribe. Pound that thumbs up button if you like the information that we're giving you guys, and follow and subscribe for more updates just like this. I'm always doing housing updates, economic updates, real estate updates. And one of the big things right now in the housing market is that we just found, I was just on CoreLogic. CoreLogic gives a lot of information and data, current data, that's updated every month at the end of the month. So on the last week of June, we get the stats of what happened in May as we're moving into June. All those stats are conglomerated. All those stats are cumulatively put together, and then they're brought out to the market. And so, look, we know that the housing market has increased by 15.4% through the month of May, year to date. And housing prices just for the month of May going into June are up 0.8%, so almost 1% on housing prices going up. Now, there was a survey that was done, and when I was reading through CoreLogic, what they asked is they asked people, do prices of homes right now, are they too high, and do you see them as an issue for you to buy? And 82% of people say yes, housing prices are too high, and yes, it is an issue. And they did another survey that asked people, would it affect their ability or desires to buy? And over 33% of those people said, yes, I will either not buy right now, or I'm going to postpone my purchase and wait for housing prices to come back down. Now, I'm going to go back through this with you guys and give you some realistic expectations as to whether or not housing prices look like they're going to go back down, what cities and what areas are going to be affected, and what areas are projected first to decrease as far as housing prices. And when can we expect to see that stuff, is the biggest thing. And so as we're redeveloping real estate, I know you guys see me flying all over the country, buying real estate, looking at real estate, creating more opportunity, more deals. And I'm going to explain to you guys while we're doing this, how and why I'm doing that, and how you can also take advantage of that as well. Because if you're following our content, you're watching this video, by this point in time, one thing that I know about you is that you're trying to become an intelligent investor. And so you're no longer out there following the masses of people that are not investing correctly. You're following the pros. You're following the people that are out there making moves in the industry right now. And so one of the big things is knowing where to invest, right? Knowing what areas where the housing prices are going up. And so when I go back, you look at statistics and you look at what 5 states lead the housing price increase. We have Idaho, number 1, over 33.3% increase in housing prices in Idaho this past year. Arizona, the state of Arizona is up by 23.4% on housing prices for the year. Utah is number 3 in line at 20.4%. Indiana is at 20.2%, taking number 4. And ladies and gentlemen, the 5th housing market where housing prices have increased the most is in Montana, of all places, has went up by 19.5%. So those are the big boom markets that have seen the largest increase in housing prices over the last year. Now, you're sitting back, you're looking at things and you say, okay, what 5 markets had the highest now currently, not just in the last year, but where are things still escalating with everything that's going on in the market right now, with real estate booming, with interest rates rising? People are sitting back saying, okay, so where are we economically? Are we going to continue seeing the housing prices go up? Are we going to continue seeing interest rates rise? Are they going to go down? Or where are we? Well, it's important to know exactly where we're at right now. And since this is the July housing market update for prior months, June and back, it's important to know the biggest markets that are still seeing the largest increase in housing prices right now. So get your pens out. Number 1, top market seeing the largest increase, and these are by cities, ladies and gentlemen. Number 1 is Phoenix. Phoenix, Arizona has seen the largest price increase in the month of May going into June. Number 2 is San Diego, California. Now, ladies and gentlemen, if you're like me, I've heard that people are fleeing California in the masses. So if people are fleeing California in the masses, I got 2 questions for you. Why in the world is San Diego seeing the largest increase in housing prices, number 2, in the country? And why are we buying real estate out in Palm Springs and building houses? Because, ladies and gentlemen, not everybody's leaving California. People are moving to California. Now, big businesses are leaving California, but people still desire to be coastal. I'll tell you, I was just out in Florida. I love Florida. I love the tax benefits of Florida. I hate the politics of California. Sorry if you guys are in California, politicians. Sorry, I think you guys have ruined the state of California. But still, by far, I got married in California up in Laguna Beach at one of the Montage properties. I'll tell you guys that we owned a property in Laguna Hills, my wife and I, and we're still going to go back, and we're still going to have a retirement home up there that we're going to be purchasing here sooner than later. And I don't know if you call it a retirement home or what you call it, but we're going to have a home up there. Again, we sold out in 2016 because the housing market was just escalating so much. We didn't know exactly how much higher it was going to go. Lo and behold, we could have probably doubled our profit if we would have hung out until today, because housing prices are still escalating. Now, third market, largest increase in housing prices in the month of May and moving into June is Denver, Colorado, ladies and gentlemen. Denver, Colorado. Number 4, Las Vegas, Nevada. And number 5 is Washington State. You know what's funny is that when you go back to 2008 and you take a look at the economic crisis in 2008, there was the 5 most distressed states in America. And so I called them the Big 5, okay? Now, one of those states was Arizona. And now it's one of the fastest, most progressive housing price increases in the country. The second was Las Vegas, Nevada. The third was California. California, ladies and gentlemen, was the third most distressed real estate in the country. New York City. Now, New York's not on here. But so out of the 5, there is 3 of the cities that had the most depressed economies still seeing the largest increase in housing prices, ironically enough. So even though they went through an economic crisis, lo and behold, they're still some of the most desirable cities to live in, obviously, and they're still going out and creating an increase in value. So for sake of example, when we purchased our place up in Laguna Hills back in 2011, we sat back and we were looking at prices. And they were at about $600 a square foot. And we did a study on the housing market. They got up to about $1,100 a square foot, give or take, at the height of the market. And so when they got up in excess of $900 a square foot, pushing on $1,000 a square foot, I told my wife, look, we're hitting the top end of this market. There's no way that housing market is going to supersede where we were in 2006 and 7. And so if we were at just just over $1,100 a square foot. We need to withdraw from the market now. So we sold, made a big profit. We were happy. We went off like a fat horse and sailed into the sunset, right? Wrong. Because now housing prices are in excess of $1,400 a square foot in that exact same market that we sold in back in 2016. So you never know. Hindsight is 2020, but we try to do these projections so that you guys get an idea historically how things are moving. Now, type 5 cities with the greatest risk to see a decline in the market. So where is it right now that you guys should probably withdraw from the market? So one of the things, as I go back and I do research, that CoreLogic has looked at is they sit back and say, okay, let's evaluate the economics of these markets. And so they rate it based on high risk, moderate risk, low risk of investment. And so if you go into Springfield, Massachusetts, ladies and gentlemen, is the number one market that they're projecting to see a decline in real estate values first. Okay. Now, Worcester, Massachusetts is number 2. So 2 cities in Massachusetts are looking to see, are projected to be the 2 markets to see the biggest dip in housing prices sooner than later. Number 3 is Chico, California. So the prices have escalated so much, they're projecting that Chico, California is going to be the 3rd largest market that's affected by a downturn economy. And they consider these 3 at moderate risk. So the possibilities of these going down in value over the next few months is 25 to 50% probability. Okay, so all this stuff is done based on probability. But those are the 3 markets that the CoreLogic is telling us not to invest in right now if you're going to be an investor, because those are the 3 markets that you're going to see a decreased value in homes projected, and it's about a 25 to 50% probability. Number 4 is Oxnard, the Ventura, California area. Number 5 is Norwich. New London, Connecticut is number 5. Now, these ones are a lower risk. They have these at less than a 25% probability. And ladies and gentlemen, the rest of the cities across the United States are still considered fair market, great areas to invest in. And for how much longer? Okay, so we're going to go through that. Now, I like doing research through the National Association of Realtors, because the National Association of Realtors, ladies and gentlemen, they give all the new data and stuff that comes out each month. And what the National Association of Realtors said is that in June, pending sales fell by 6%. Now, that's 6% from last June. So if you take a look at what last June sales prices were doing, the pending sales right now have dropped 6% as opposed to pending sales a year ago in June. So from 1 year ago. Now, is that an effect from interest rates? Interest rates are up over 3%. So is that an effect from interest rates increasing? You know, we went up to like 3.6%, 3.5%. Now they're down to 3.1%. And so we're about a half point down from where they were at the height this year. And in the same price to go into some of these assets, it's costing people more money to go in and buy these pieces of real estate if the interest rates go up, because they're spending more money on interest. And so there's the new listings on the market. We're starting to see a lot more of them. So people that are wondering about inventory, we're still hitting an inventory crisis. But this last month, we saw an increase of listings of 6.3%. That's a good number. So that means that more houses are going on the market. But there's less of them that are going into pending sales. So 6% less and 6.3% more homes on the market and 6% less pending. So ladies and gentlemen, what does that tell you about what's happening in the housing market? And this is all from 1 year ago, ladies and gentlemen. And so things are going to start looking like they're going to start stabilizing. But are they really going to stabilize long term? Are we going to continue seeing increased values? And are we going to still continue seeing inflation happening? And so I'm going to go in here. You know, people ask Jerome, how do you know that this stuff is going to sustain? Well, there's different things that we look at. When we're looking at this stuff, I look at the U.S. Treasury yields, and the U.S. Treasury yields right now, if you look at the last 10 years, the 10-year U.S. Treasury note has dropped from 1.6% to 1.4% just over the last year. And so anytime the U.S. Treasury yield tends to drop and unemployment is high, and unemployment is high, ladies and gentlemen. Unemployment is just over 6% right now. And so once you get over 6%, that's a high unemployment rate. That's when you look at that stuff, anywhere between 6 and 8% is what we've been floating over the last year. Now, we've dropped a couple percent since the mass chaos of the pandemic, but we're still at a high unemployment rate. And what's that reason? Okay, well, this might help you guys. I want to go through the difference between a deflationary market and an inflationary market and how this affects real estate. Because, ladies and gentlemen, what most people, if you go in and you take a look at what economists are saying, there's a dispute between the two. And so Forbes magazine, if you go into last month's Forbes magazine, they talk about this dispute between economists and what they're projecting. And there's some economists are saying, hey, we're not in an inflationary market, we're in a deflationary market. And some economists say, no, we're not in a deflationary market, we're in an inflationary market. So what's the difference between the two? So when a market is deflating and you have a deflationary market, that means that your dollar bill is that your assets are going up in value and that money is stronger. An inflationary market is when the prices of things are going up in value, but the dollar bill is getting weaker. Okay. Now, in a deflationary market, your dollar bill typically gets stronger. Okay. Now, you can't be in a deflationary market and then also have stocks booming and going through the ceiling. So we're seeing a bunch of the stock market. We're seeing assets going up and in value. We're seeing the stock market just thriving. So how can we sit back and go, okay, how are we really in a deflationary market? Well, let's see. So here's some signs, and I'm going to kind of read this to you guys. If unemployment is high and the demand for supplies is weak, the supply chain will be resilient and offer plenty of goods to increase the demands. Okay. Now, quantitative easing. Now, quantitative easing doesn't create inflation. New money gained and balanced by less liquid assets less in exchange. The new money is encumbered by this process. So it's easily squandered on immediate or rash purchases. Okay. So that's when when we're getting stimulus checks. This is what's happening with the economy, right? We're going in and they're giving stimulus money to try to stimulate the economy. And so they're printing our Federal Reserve, they're printing a bunch of money and they're putting it out into the economy. And so what economists are saying is they're not on rash purchases. People are getting money, they're spending it on logical stuff. Now, ladies and gentlemen, what I've learned and what I've read, it tells me that everything in the world, you take a look at people winning the lottery. Statistically, people who win the lottery are worse off financially in less than 5 years than they were prior to winning the lottery because they weren't mentally prepared for the capital and the money that they were granted, that they were given. Okay, they didn't know how to spend it. They didn't have financial literacy. Hence, they spend it frivolously. So they spend it on rash purchases. Okay, they said if you took all the money in the world, all the wealth in the world, and you spread it equally amongst all people, in less than 5 years, it would be back in the exact same hands that it is in today. And here's why: because wealthy people think different. And the problem is that most people don't know how to invest and have no financial literacy because it's not taught in school, ladies and gentlemen. Financial literacy is not taught in school. I talk to my kids, and when my kids were younger, they just thought that you just had indefinite amounts of money on your credit card, right? So now when I pay my credit card bills every single month to get airline points, travel points, and all the free perks and whistles without getting hit with interest hikes every month, we go in and pay it off. And I say, okay, ladies and gentlemen, this right here, I tell my kids, is what we spent last month. And I show them the bill on credit cards. Now, this is not our money. Now, we have to take our money. This is our bank account. This is our money. We're going to take this money that's ours, and we're going to pay the bank back because the bank lent us this money for free for 30 days. Thank you, bank. But I don't want to pay them more money, so we're going to pay it back. So I show my kids how it works transitional-wise, and then I talk about financial literacy so they understand it. Okay? Now, What does that have to do with the housing market? I don't know. But I wanted to share that with you guys because it all has to do with financial literacy, right? And so when you're talking about a deflationary market, the stimulus checks will not create inflation. That's what economists are saying. They're saying it will not create inflation, okay? And might not even prevent deflation, but it will support and smooth out the future recovery back to normal. The proof is in the pudding of the last 12 years. And so they're saying that by handing out money to the American people, it's not going to create inflation. Okay, so let's look at inflation, ladies and gentlemen. Let's take a look at inflation, and let's look at what economists are saying in regards to inflation. Okay. So we take a look at inflation, what economists are saying. I'm going to read you guys the actual disputes and what they're saying. Now, an inflationary market, okay, you simply cannot cancel interest rates. Okay. Now, I don't know about you guys, ladies and gentlemen, but I can't just magically cancel my interest rates on my credit cards, my house, on cars if you have them financed, whatever it is. I can't just cancel those out. You can't. It says you simply cannot cancel interest rates, pump untold amounts of new money into a seized up economy and expect it not to create inflation. It always has and it always will. Okay, look at what's happening to lumber. Look at what's happening with the crude oils. Look at what's happening with building materials. Look what's happening with everything. I just purchased a brand new truck, and the same exact truck that I purchased 3 years ago, I went and bought the exact same truck, brand new, went up over. Typically, they go up about $10,000 every 3 years. That's been historically since I've been buying them every 3 years for many, many years. Now, this year it went up 15%, so 5% higher than what it was 3 years ago on the projected increase. And I wound up spending an extra $5,000 on that vehicle as opposed to what I would have spent otherwise. And I actually spent more than that because there was less rebates. So I actually wound up spending about $12,000 more out of pocket than I would have, than I had pre-anticipated because of just the inflation of everything that's happening right now. So ladies and gentlemen, I don't know about you guys, but I keep getting bills from suppliers and letters from suppliers telling me that prices have continued to go up. Roofing materials, cement, concrete, all of that stuff is going up. Everything with the crude oils, from paints, elastomeric stuccos, everything, lumber, steel, everything. It just continues to go up. Now, things are starting to stabilize a little bit, but they're saying that this stuff, that when they're printing money, it doesn't raise and inflate prices on stuff, okay? Now, inflationary argument. You can build a tower of debt, but if you keep building it, at the same point, it's going to fall. Ladies and gentlemen, you ever stacked cups, like solo cups, into a pyramid and you keep going, keep going, keep going? Or you ever played with dominoes and stacked them, and then sooner or later you hit one, and then it's just a domino effect and they all fall down? Well, ladies and gentlemen, that's inflation. That's a bubble. When you go in and there's a bubble and you can blow and blow and blow, and then sooner or later it has to give, okay? And so that's the market that we've been in. But if you keep building it at the same point, it's going to fall at some point in time. As the tower gets more and more convoluted and bigger, it must at some point collapse. That's when inflation occurs, because it is the only escape. Now, ladies and gentlemen, this has been happening not just in the United States, but in other countries, in Russia, in Europe, all over the world. Inflation has happened at some point in time, and it's happening to us right now. Out of control economies always end up in inflation because it's the only way government can default on their debt. And so, ladies and gentlemen, I've been talking about this ongoing, okay? And so I think we just defined whether and found out the real winner of this argument. Are we in a deflationary market or an inflationary market? Just look around, ladies and gentlemen. You don't even have to listen to me. Just look around at what's happening right now, and it's easy to agree that we're in an inflationary market, ladies and gentlemen. We're definitely in an inflationary market. Now, I go back and I talk to you guys about the Federal Reserve. It's a non-governmental agency. Some people right now are going, what? The Federal Reserve is a non-governmental agency? That's right. That's correct. That's what I said. The Federal Reserve is a non-governmental agency. Did you guys listen to the last bullet that I read there? Out of control so the inflation argument, number 3, out of control economies always end up in inflation because it's the only way that governments can default on their debts. Why is that important? Because, ladies and gentlemen, the federal government borrows money from the Federal Reserve, and they pay the Federal Reserve interest. The Federal Reserve is controlled and ran by our central banking system, by the big banks, JP Morgan, Merrill Lynch, all the big guys. They run the Federal Reserve. And so that debt is paid back by the federal government when more money is printed. Where do they get that money from, ladies and gentlemen? Put in the chat if you know where they get that money from. So I'll tell you guys right now, they get that money from us, ladies and gentlemen. That's what you call taxes. And so what lands up happening is through interest rates, through taxes, we land up paying back that interest rates on behalf of our federal government. And so Sam, you're 100% right. You get it from us. You get it from the U.S. public. And so understand that the way money works, ladies and gentlemen, is you can make money you can make money whether money's is in inflation or in a deflationary market. Now, obviously, when you're in a deflationary market, your dollar gets stronger, right? So everything you're doing is it goes up. But let me tell you guys, I'm going to tell you guys the little liquid secret here of what you should be investing your money in. So if you've been following my content, you know that I'm in real estate. And there's a reason that I'm in real estate, because real estate is one of the number one most incredible wealth building tools in the world today. Okay. And so people are sitting back and they're going, okay, Jerome, you just went over the housing market. Why in the world should we continue investing in real estate? Here's why. Because we are in an inflationary market right now, and things are going to continue to get more expensive over the next 5 years, or give or take. And so understand that if housing prices continue to go up, real estate continues to go up, what happens to our dollar bill if we're in an inflationary market? It continues to drop. And so, ladies and gentlemen, when you go down to the gas station and you pump gas into your car, do you go up to that counter with a brick of gold or silver and say, "This is real currency"? Boom, sliver off a little piece of my gold and silver, and I want to pay for that gallon, those 30 gallons of gasoline in my vehicle? Do you go in and walk in there with your credit card or dollar bills and pay for that gas? Ladies and gentlemen, the number one only real asset in the world today is real estate. And the reason why is because as your dollar bills go down in value, the real estate continues to appreciate in value. And here's how. Because as the dollar bill gets weaker, the same $350,000 house, that's what the $350,000 is what the National Association of Realtors right now says what the median home cost is nationwide. So the median home cost nationwide is $350,000. So ladies and gentlemen, what happens if that house doubles in value over the next 5 years? If money continues to get printed, if we continue to live in an inflationary market and the cost of goods and services continue to go up and the dollar bill gets weaker, you can no longer buy that same house that you're buying today for $350,000 5 years from now for $350,000 because the dollar bill is weaker, ladies and gentlemen. The dollar bill does not buy the same amount of bread. It doesn't buy the same type of automobile. It doesn't buy the same type of real estate in 5 years from now. So the reason that real estate is so incredible is because you can utilize real estate as a tool, as passive income. If you have multi-unit real estate and you can continue to go out there and get and receive checks every single month from tenants, every single month. And as the dollar bill gets weaker, guess what you can do to your tenants? You can charge them more money to live in your properties. You can charge businesses more money to lease your retail, your office. You can charge people more money to live in your apartment complexes. Ladies and gentlemen, in an inflationary market, if you're in the right industry, you benefit. And real estate, ladies and gentlemen, is the right industry to be investing in right now during an inflationary market. Now, this will continue. So the way we buy, the way we build, the way we go out and facilitate business is always depicted upon the economics of what's happening right now. The only people that lose are the people who are not willing to pivot. And so, ladies and gentlemen, there's no better time to invest in real estate than any other time in the world than right now. And when all of this is fixed, there'll be another opportunity in real estate, and how you buy will be slightly different. But ladies and gentlemen, real estate will still be the number one asset class that's producing more wealth in America than any other industry in the world. And so I tell people, the only true real asset, even over silver and gold, because silver and gold, it's worthless unless you melt it down, you sell it, you weigh it, and you sell it off to a pawn shop, or you sell it on the open market to get money back on so you can go spend it. But in real estate, you have passive income. And that passive income grows as your asset goes up in value, as the dollar bill goes down in value, and things inflate. You could charge more rent. Not only that, it costs more money to buy that exact same asset. So let's say you go in and you buy a $600,000 apartment building that's a fourplex, and so you go buy a fourplex for $600,000. The same property that you bought for $600,000 because rents have escalated. Now the dollar bill has deflated in value. Now it's going to cost you $800,000 to buy that exact same building in maybe 3 years, 4 years from now, or less, depending on how inflation continues over the next few years. And so, ladies and gentlemen, the best asset class to invest in right now as a smart investor, and if you're watching this, you are a smart investor. And ladies and gentlemen, if you like the information, the content that you're hearing, give us a thumbs up, subscribe to our YouTube channel, pound that bell, and subscribe to our YouTube channel for more content just like this. I'm always doing housing updates. I'm always giving you guys golden nuggets on how to invest and reinvest in real estate, how to go out and buy land, build houses, deploy that money into long-term holdings and multi-unit real estate so that you can retire one day. So that, ladies and gentlemen, you can go out and create generational wealth for your family. And if you don't want generational wealth, that's fine. But how about financial stability in your life? How does financial stability sound to you? And so, ladies and gentlemen, we're living in a day and age where things are inflating, and you don't have to do anything more than just look around. And the more I look around, I sit back and I say, okay, how do we benefit from this? And we continue to buy real estate. So I just got back from the title company. I just FedExed out some documents back over to California. Where we just purchased 3 more lots. We're going to build 3 homes, and then we're purchasing another 3, and we're going to build another 3. So we have 6 homes going up in the Palm Springs area. I have stuff going on all over the place. And we sat down this week, and Ty Lopez and the rest of the crew, we're doing some stuff. We've been doing real estate up in Puerto Rico. And so one of the big things, ladies and gentlemen, is we sit back and we say, okay, where is opportunity lay? And we just underwrote about a $12 million profit on 4 pieces of real estate that we own in Puerto Rico. Ladies and gentlemen, 4 pieces of real estate, $12 million in profit. So we're listing the properties to sell them, and we'll deploy that into other assets and long-term holdings. Where in the world are you going to find a 40% return on your investment in less than 1 year other than real estate in the right market? Now, ladies and gentlemen, I'm not going to sit here and tell you that's going to happen to you guys, but I am going to tell you that there's opportunity out there. Why are we still turning dirt in Washington State? Why are we still going in and we're underwriting deals and still building out developments? Because there's a need. There's a housing shortage. Right now, the millennials are at an age where they need to invest in something, whether it's they're going to go and live in an apartment, multi-unit real estate, or they're going to go in, they're going to invest in a single-family home. Ladies and gentlemen, as they have kids, they get married, and they start having families, there's going to be a need for rooftops. And it's already happening. It's happening right in front of us. I remember looking at our market here in the Albuquerque market, which is not a strong market, ladies and gentlemen, and I made millions of dollars out here. And I remember sitting back with buddies of mine years back and sitting back after the recession of 2008, back in about 2012, we were sitting having lunch one day at a Thai restaurant, and we sat back, and one of them came up and said, man, Jerome, we did good. We got through this shit, meaning the recession, right? The economic crisis of 2008, we got through it. And he goes, we're still going through it. And he said, you know, Jerome, if we can get wealthy in this market, we can get wealthy anywhere, because this market is a real pain in the ass. And I'll tell you, I don't live in a market that stimulates the best economics across the country. We live in an economy. We live in a market where our economics don't really make sense. We're finally starting to get a little bit of leeway. But ladies and gentlemen, in that economy, I've still made millions of dollars. And so, ladies and gentlemen, we sit back and I look at everything that's unfolding right now. And yes, my money deployed into other cities makes more money. But the whole point being is that if you can come in to an economy even like this and generate capital and do well, you could go into other economies and deploy capital and do extremely well. And so right now, ladies and gentlemen, is we have a mass need for rooftops. Even here, I went back a year and a half ago, and a year and a half ago, they said, Jerome, we need 15,000 rooftops total in the city of Albuquerque and within our local area. And so I went back and I said, okay, ladies and gentlemen, where are we now? And do we still need 15,000 rooftops? And they said, yes, we sure do. We need 15,000 single family rooftops in the next 2 years. And I said, oh, okay, so nothing has changed in the last year and a half. They said, no. A year and a half, 2 years ago, we needed 15,000 rooftops total, multifamily and single family. Now we need 15,000 single family rooftops and 7,500 multifamily rooftops in 2 years just to fulfill the current need for housing today, right now. Ladies and gentlemen, I go back and I do this market research in other cities, and I sit back and find that there's big progressive cities like Phoenix that need over 25,000 rooftops over the next 2 years to fulfill their current need for housing. So where is it going to be in 2.5 years from now? And so, ladies and gentlemen, that's the type of stuff that's creating the market that we have. And that's what's going to continue to create inflation, is that our federal government continues to print money. As the housing market crisis continues because there's a lack of inventory, housing prices are going to continue to escalate. The dollar bill is going to continue to go down in value. And so, ladies and gentlemen, where should you put your money? Ladies and gentlemen, you should put your money in real estate. Why are we taking distressed office buildings and why are we deploying them into multifamily? Because there's a need, ladies and gentlemen. And I want to make sure that we're taking advantage of a percentage, as much of a majority of that percentage that I can get my fingertips on, I want to take advantage of. And that's why you're seeing us all over the country deploying money and capital into developing all over the place, because we're trying to get little bits and pieces of the market sector everywhere we can that we know there's good returns. So we have a few questions here, and we have a few minutes for a few questions. Alex, is it a good investment to build three hours away from major cities? Yeah, if it's growing in that area. So 3 hours away from major cities, 3 hours is a long distance, okay, first and foremost. So it depends specifically on what that city is doing. So we're buying real estate in some remote areas where there's major interstate corridors for industrial warehouse space. Well, that makes sense because they're byways between there are major arteries between other markets, right? So it makes sense for us. Now, 3 hours away, it depends specifically on what's happening 3 hours away from large cities. Now, if there's a progressive growth 3 hours away, like let's take, for example, Colorado Springs and Denver, Colorado, right? When you move into like Pueblo, Colorado, which is about 3 hours away from Denver, you sit back and I scratch my head and I say, okay, well, is Pueblo, Colorado growing? I don't know. I don't know what Pueblo is. It's a small town. It's a big old industrial town. Denver's growing, and it's grown all the way into Colorado Springs. So I know Colorado Springs is booming and growing, and that's 1 hour away from Denver. So they've seen the roll off from the growth in Denver. Colorado Springs has. So 1 hour away, we've seen that. Now you take a look at cities like San Antonio and Austin. I-35 between San Antonio and Austin. When I lived in Texas back in the 90s and I owned a house back in Austin up until the mid-2000s, I remember driving I-35 and it'd take an hour to get there. You could go 85 miles an hour and get from San Antonio to Austin. Now, it doesn't exist, ladies and gentlemen. You're going to sit on on I-35, and it's a big, giant parking lot, just like the Los Angeles freeways, because it is bumper-to-bumper traffic. And everything between San Marcos, New Bronxville, all the way down I-35 has grown together, just like Denver and Colorado Springs has. And so you see apartment complexes that have went up. You see housing that's went up. So the answer to your question, Alex, is you got to do market research. You got to go in and see what's happening in those areas. Because if you take a look at market sectors like that, and there's major cities that are arteried together, yes, there might be great opportunity out there. You take a look at Dallas-Fort Worth and the arteries that connect Dallas-Fort Worth to Austin, and going up towards like Amarillo, you can see what's happening. But there's a lot of small city sectors. There's a lot of small farming communities out there that might be decreasing in population. So you might want to caution yourself. 3 hours is a long distance. 3 hours, 3 hours is 200 plus miles away from each other. Okay, so you want to be careful. That's a big variance. Now that people are moving away from, so that's part of your other question. So is it 3 hours now that people are moving away from big cities? Well, are people really moving away from big cities, Alex? I guess is my question to you. I think people want to live in the suburbs. I'm a suburb liver, but I look at my brother. My brother lives in Manhattan. He's lived in Upper Manhattan for a long time. He lived in San Francisco for a long time. I look at people like Dr. Alex Mehr. When I talk to him about moving to Puerto Rico, he misses the big city. He likes Puerto Rico. He likes it, but he doesn't love it. He's there because of business and taxes, but he loved San Francisco. That's where his heart is. My brother hated New York during the pandemic because it didn't offer the lifestyle benefits that he loved out there. Being able to walk, hit the subways, entertainment, the city that never sleeps. All that stuff was gone during the pandemic, so it was a very depressed place to live. But now he won't move anywhere else. He had talked about moving from there at the time when the pandemic happened and moving back towards San Francisco. And now he's back, and he just signed another lease, and he's there for another 3 years at least. And he moved into a nicer place, just was able to scale up on his real estate, but he stayed in the city. But my brother's single, right? He's 40 years old, he's single, and he loves that inner city living. And so I think what we're going to find is that people don't really love to live completely remote. Like, I love living at remote where I live, and I don't want to live around people, but I love being close to the city. 3 hours is a hike. I don't want to live 3 hours away. We were just down in Florida, and I was looking down at Anna Marie Island, and I was looking at the real estate down in Anna Marie Island, and I sat back and go, man, I didn't realize how gorgeous this little island was. And we took the bridge over into the island, and we drove around Anna Marie Island in horseshoes all the way around. And at the end of this island, the road dead ends into one of the best sushi restaurants that I've ever eaten at. Probably top five. Now, Uchi's in Austin is number one, but one of the top five in Anna Marie Island. I would have never known. We didn't even know there was any restaurants out there. We were just exploring the area. But what we found about it is, I said, I told my wife, if I lived out here in St. Petersburg, Tampa, any of these areas, I would be living here, because the commute out of there is not bad. It's remote living, but it's close to life. And I love life. And I think most people do. They want to see, they love seeing life. I don't know that people want to be 3 hours away in remote areas. I think maybe 1 hour away, you'll be okay. I think once you supersede an hour, things change logistically. Now, people on the East Coast, I know there's people that are in Washington, D.C. that commute to New York City. But that's quite a commute, and the mass majority of people don't do that. That's abnormal for most people. So we want to look at the mass majority of what people are doing. Sam, how do you figure out how many homes a market needs? Well, that's what the Census Bureau does. You go in, you look at analytics, you go in and talk to the progressive growth planners of each city. Every municipality has a progressive plan, and they know what's going to be needed because of what's being permitted, businesses that are coming in, economic growth. So they see this stuff. They do their census bureaus that they come out with. So I go in and I talk to the city development planners, and I go in and talk to the progressive planners of the city. And so I sit down with them and I ask them those questions, and they have all those statistics. Most major cities have those statistics. I think every major city has those statistics nowadays. And so you're able to get those statistics. And a lot of that stuff is all public knowledge. And so you can even Google it. Make sure that if you Google the information and you're getting it from a good lead source that is giving you good feedback. But if you deal with local cities and municipalities, they'll tell you. And so, ladies and gentlemen, the housing market in 2021, July update. Look, is there a big variance? There's a little variance. And so my projection is that it's a good time to buy real estate. Housing prices continue to escalate. Money is going to continue devaluing, and it's the perfect asset to invest capital in to see returns long term. Because what's going to happen to the stock market? Is it going to continue going up? We're going to start seeing, as there's inflation, we're going to see things go up. But as things start to stabilize, we're going to see the stock market start to drop. And so, ladies and gentlemen, as this happens, real estate will continue to appreciate in value. So the smart and wise, the financially literate, and those that educate themselves will invest in real estate because it's one of the smartest assets to invest in. One, because if you have multi-unit real estate, your income goes up as the cost of living increases, so your cash on cash return increases. And then your internal rate of return, the return that you get from an asset when you buy it and then you sell it, also goes up because the dollar bill gets weaker and the value of that asset continues to grow in spite of the dollar bill going down. Not only that, ladies and gentlemen, if you follow my content, you want to know how the third, fourth, and fifth ways to save on real estate, to make money in real estate are, you're going to have to follow my content. You're going to have to pound and subscribe to our YouTube channel. Learn how you can utilize real estate as a tax shelter. Yes, ladies and gentlemen, how you can go out, buy land, build houses, take all that capital you make and deploy it into assets by expensing it, and how you can go out there and take that money back out tax-free, and how real estate is one of the best tax shelters that you can have as an American. Ladies and gentlemen, it's Real Talk on Real Estate. It's Wednesday afternoon. If you love the content, you want to see more content just like this, pound and give us a thumbs up button to let us know that the content we're giving you is of value, and click and subscribe to our YouTube channel. Ladies and gentlemen, go out there, make it a great day. God bless, and go out and compound your success.